but average person might be very challenged doing that. Another example is the United States. So the United States put all these regulations, and now the SEC need to issue regulation regarding them to make this legislation that was passed through the Jobs Act viable. And the SEC is finding it very hard to provide the model for which they need to follow regarding this. That's why, even though the legislation has passed a couple of years ago, SEC has still not done anything about it. Well, they have been putting proposals, but these proposals have not been adopted. They are saying now it's October 2015, the earliest that they will be issuing the regulation regarding crowd equity funding. So there is this challenge between finding stability and competition. Now, in Australia there is lots of talk regarding this. We had the CAMAC report on crowd equity funding. We have the Treasury discussion paper regarding this, discussing, okay, what kind of regulation do we need? Now, first of all, Australian fundraising provision, as you know, are found in Chapter 6D. Public companies can raise capital by issuing disclosure documents, which can be quite costly. That's why we have a number of exemptions under Section 708. Now, one of these exemptions in particular is the small-scale personal offer, which allows companies to raise $2 million within a period of 12 months, targeting 20 investors. Now, this small-scale personal offer exemption has been used in Australia to create something akin to crowd equity funding through the Australian Small-Scale Offering Board, ASOP. And ASOP has been its success is mixed. It has been able to attract a number of businesses to try to raise capital. There are success stories, they are there, and they have been using the class order 02/0273 to be able to do the advertisement and avoid the advertisement requirements that are present under the Corporations Act. But ASOP has been saying this is not crowd equity funding, which I agree with. It's sort of financing that, if you want to call it crowd equity funding, it's at the top, because it's limited by the 20 investor rule. Now, CAMAC came with a number of suggestions to introduce rules regarding crowd equity funding. And the question, is that proposal that is put there the right balance between stability and competition? I have personally some concerns regarding this. The first suggestion, there is 3 requirements that need to be there. So regulating the business, regulating the intermediary, and regulating investors, which is very important to look at all 3. The first one is regarding business. Who can actually use crowd equity funding? And CAMAC, one of the suggestion is we need to create a different type of company. So exempt public company, and these exempt public company would be able to use crowd equity funding. These exempt public company will be able to do it, and they won't have the disclosure requirement attached usually to public companies. And they don't need to call for annual general meeting and so on. And when I looked at this, I was a little bit surprised, because the Corporations Act is very complex legislation in the first place, and adding another level of intricacy in it is not always helpful. Now, this concept is a little bit too complex, because this exempt public company that is being created will not last for a very long time. It will last for 2 to 5 years, and after that it will become a public company. So the question is, if you go with an exempt public company now to be able to do crowd equity funding, you have to understand that the privileges that you are getting now will no longer apply in a period of time. And they may not apply earlier if you have raised above a particular amount of money. So it's a very complex system. The easiest way to deal with this is follow in New Zealand, the New Zealand suggestion, the New Zealand laws regarding crowd equity funding, which is just put a limit of 2 million, 12 months, open it to companies that are registered, and as a result of that, you will have a viable system and less complex system than creating a new type of company just for crowd equity funding. Now, in addition, I think to protect consumers, one additional protection that can be put there is when a business wants to raise money, they want to do it for a particular purpose, but this purpose may not be achieved directly. There will be a number of milestones that are there. So my suggestion would be, if the business wants to raise $2 million, which is the maximum amount they can raise through quad equity funding, instead of telling them, yes, you can raise $2 million in one go, you'll tell them, you need to raise it by milestone. So your first milestone in your project requires $100,000. So that's the amount you will be able to raise. Then when you reach that milestone, you will be able to go to the next milestone, and the next milestone, and the next milestone. And this will show first that the business actually is viable, it has the resources to achieve its target, and it will give an indication to investors if these targets are reached on time or not. And if they aren't reached on time, when the business wants to come back to raise more money, they have to explain why didn't they actually meet the first milestone on time, like they said. So that's the first thing. The second regulation is regarding intermediaries, and this is very important. So CAMAC is proposing a licensing requirement, which is very important, so AFSL. Now, this is great because we need to make sure these intermediaries are actually have the necessary resources to do what they want to do. With the AFSL, with the licensing, it will allow them, for example, to make sure they have due diligence. It will make sure that they also have external dispute resolution. They are registered with external dispute resolution if there are problems, and so on. Also, one key thing that has been happening when you look at crowdfunding in general around the world is that these crowdfunding platforms, the intermediaries, are not actually making profit. They haven't reached that level where they are making profit. So as a result, there is a risk that they go bust. And this has been happening around the world, intermediaries just disappearing overnight. And they haven't been keeping the right systems in place. So they haven't been keeping who are the investors and so on. So when they disappear, no one knows I invested in where and so on. Now, so individual investors had to follow up and try to contact the businesses to see what's happening and so on. And that has been a huge problem. And even ASOP, the Australian one, platform, is not operating at a profit for the last 4 years. So there is this problem that with intermediaries, that they may go bust. So regulating them and making sure the regulation is right is very important. Now, the last protection that is put there is regarding investors. So CAMAC is proposing to limit how much investors can invest. So they are saying for a person, they will be limited to $2,500 per company and $10,000 per year. So that would be the limitation that is there. Now, this limitation is based on choice architecture. So investors cannot actually, if you give them more choice, they will be making bad choice. So we need to limit their choice and curtail them. And that might actually be fair if we look at original literature regarding the behavior of the crowd. And in original literature, for example, we see Tart saying the crowd will be sucked in through imitation and they will be doing what other people are doing. And Le Bon will be saying, oh, the crowd is barbaric. It has inferior intelligence than the individual intelligence. So they will be making very poor choices. They are very primitive and they won't make good choices. But if we look at more recent literature regarding this, people are starting to talk about the wisdom of the crowd. The crowd can actually make the right decision, and on average, the crowd does make the right decision. And in addition to that, one of the key things with crowd equity funding and crowdfunding in general is it will attract different types of people. So it will have a diversity, and this diversity may actually help introduce different information into the market to be able to to allow the crowd to make good decisions. Also, when we look at peer-to-peer lending and the experience that people have been having with peer-to-peer lending, now we notice that there are certain signals that people are looking at before they invest in businesses. Now, so some of the signals is usually people understand that in the first three groups of people would be investing in businesses, and that's the 3 Fs: family, friends, and fools. Now, so they will not usually invest except if these people have invested over 50% of the money that is required. Once that target is reached, it attracts other people to come in and start investing. Now, so that's what we have been seeing through peer-to-peer lending. Also, another signal is if there is no disclosure requirement, that is, people are not issuing disclosure, telling the outsiders exactly what they are doing, what are the risks involved, investors generally are not willing to invest in the venture that is being put forward. And also, if we forget all this, let's say we implement this limitation. We say, yes, investors will be limited. How are we going to enforce it? Who will be the person who will be making sure this is being enforceable, that the investors are actually complying with this? And if they don't comply, they invest more than $10,000 per year, then what penalty will apply? Are we going to fine them? So there are these logistical problems with enforcement and regulation of this particular requirement. And also, when we look at investors, and this is one of the first time where you see people who have never been interested in investment starting to get excited about it. And we should take that as an advantage. We can start a financial literacy campaign targeting quad equity funding, starting from there and building on that. There are some very cool exercises you can do, for example, at schooling to help students understand quad equity funding, the risk involved, and so on, and start getting them involved in this process because it's a hand-on process. Same thing, investors who are interested in crowdfunding would be interested in knowing what are the pitfalls, what are the risks that are involved, what things they should actually look at. So all these things are quite important when we are considering regulating crowdfunding. So from my perspective, limiting how much investors can do will not necessarily protect investors. What needs to be done is having the right regulation for businesses to make sure they are viable, and for the intermediaries, so they will have obligation there. What investors need to do is really follow the New Zealand model, which is just sign a risk acknowledgement statement, and then allow them to experiment with the market. And that's it for me. Thank you. Any questions? Okay, cool. Thank you.
This final presentation is based on some work that I'm doing with Deb, and we're going to look at some of the issues in the balance between competition and stability. But I'm going to focus more on competition than stability. First, however, I'm going to acknowledge that stability is a critical issue in the financial services sector, particularly, as Marina has mentioned, in the protection of consumers. However, a 2014 Deloitte Access Economics report underscores the potential shift that's occurred in the balance between competition and stability since the global financial crisis. It refers to the comments of, Professor Graham Samuel, who's here this morning, and cites a statement by Professor Samuel that some mergers that occurred may not have been allowed if financial stability had not been prioritised over competition. And if Professor Samuel was misquoted, he can say so in the question session. The report further underscores the level of concentration, which Deb has pointed out, in retail banking in Australia by comparing it to European countries. Using ECB statistics and APRA data, the piece finds that the level of concentration in retail banking is higher in Australia than in the EU. And there's no trust-busting power for competition regulators in this country, and there's no equivalent to a referral to the Competition and Markets Authority, the one that Deb mentioned, in the Australian system. And that's probably why there's an argument that the focus should be less on competition stability balances and more on whether it's possible to increase the vibrancy of competition between the existing and very stable players. I'm going to look at whether there's a balance to be concerned about, the effects of too big to fail banks in Australia, and then ask whether competition is at risk. The majority of what I'm going to say is going to be looking at consumer switching costs, with a final review of whether increased competitive intensity is possible at all. Competition in banking acts to increase social welfare in the same way that competition works in any other sector. The academic literature on the balance between competition and stability in the financial services sector follows two competing views. There's the competition fragility view, which says that competition lowers bank margins and consequently encourages adverse risk-taking, and the competition stability view, in which market power and the provision of services such as loans potentially exacerbates moral hazard and adverse selection problems. Put more directly, the conventional wisdom of competition fragility sees monopoly rents as key to bank success and their erosion through greater competition as causing bank failure, while the more recent competition stability view sees the probability of bank failure increasing in line with increasing concentration in that banking industry, while noting that increased concentration doesn't necessarily mean less competition. One of the issues in the balance between competition and stability is whether there is really a stability benefit, as set out in the quotes on the slide. In addition, we have the IMF suggesting that stability itself can be problematic, and using Australia as an example, one of their reports says, dominated by the four major banks, the Australian banking system is one of the most concentrated in the world. The four banks have similar business models, and such similarities may be a source of contagion risk. The similarities in their lending and funding mean that stress in one bank could be quickly transmitted to others. That is, stability has the potential to domesticate systemic risk. The issue of high concentration in financial services is also linked to the risk of the formation of oligopolies, whereby there are a few firms that become systemically important and are therefore referred to as too big to fail. In 2009, the OECD reported that prior to the financial crisis, in many countries, the financial sector was already oligopolistic, and it was this structure that was partly responsible for the crisis, rather than competition. This line of argument is based on the fact that because of this oligopolistic structure, many of the banks were systemically important, and this created what the OECD called moral hazards, guarantees, and excessive risk-taking. So the OECD argues that more competition combined with prudential regulation is needed for stability. Another report by Beck argues that major reports by the Bank for International Settlements, the IMF, and the Group of 10 have raised concerns about the accelerated concentration of banks within countries and across countries in the past decades. As a result of this, institutions that are too big or too important to fail may make it difficult for authorities to interfere. Moreover, the complexity of these oligopolies, for example, combining retail banking with wealth management, makes it difficult for regulators to properly supervise their businesses. The Murray proposal for increasing regulatory capital is one approach to the too big to fail issue. However, without consumer options, the cost of increased regulatory capital is likely to be borne by bank customers in an environment where there are few alternate providers, or at least few realistic alternate providers. So is competition a risk? Well, yes, but competition is potentially risky, but it also opens opportunities. The rise of competition from peer-to-peer lenders and other competitors will either grow and thrive, or it won't. And it doesn't need, potentially, doesn't need competitive regulatory intervention, merely the absence of anti-competitive regulatory intervention. Arguably, the key thing about competition is it's just easier to embrace it than to fight it. In Australia, in common with other OECD countries, switching by consumers between financial services providers is relatively rare. There's the phrase that I was taught at school, coming from a country a long way from here: man is more likely to change his wife than his banker. And part of the reason for that is the switching cost. Low switching barriers, that is not just price barriers, but non-price barriers, might provide an opportunity to increase competitiveness without losing the stability benefits. A 2009 OECD report demonstrates that retail customer switching is low. The importance of the customer's ability to switch was looked at by this and subsequent OECD reports, and they emphasise that consumer policies are a necessary element for competition. The ability for customers to easily switch is crucial for competition, as consumers would be able to choose the best options for themselves, creating competition and forcing competitors to keep charges at a minimum. This OECD report argues for greater consumer education, financial literacy about alternatives, and transparency, as well as studying the practicalities of implementing account number portability schemes to make it easier for consumers to switch and thereby promote competition between financial institutions. If you want to understand the effects of portability, then you need look no further than your pocket or your bag. Number portability for mobile phones in Australia was introduced in 2001, and the effect on both penetration of mobile services and competition was significant. Hal Singer in the US has estimated that the benefits of the introduction of mobile number portability in the US can be demonstrated to be billions of dollars per year. In the financial services sector, Lumpkin finds that the ability of customers to switch is necessary for competition. Without this component, financial businesses will have fewer incentives to compete. He also notes that retail financial consumers rarely switch to new service providers and finds that there are essentially three reasons for this. First, switching costs are too high. Second, there are high search costs. And third, from the perspective of the providers of financial services, there is an adverse selection problem. The search cost dilemma is that financial products tend to be very complex. Upfront fees and charges mean that there are fewer incentives for customers to switch. In terms of the adverse selection problem, Lumpkin notes that when a customer switches to a new institution, they don't have all of the information that has been attained from the last provider, meaning that the new provider may have lower quality customers and potentially unfavourable terms. To counter the impediments to switching and for customers to make properly informed choices, he argues for specific rules by regulators to prevent unfair and deceptive practices that exacerbate the information asymmetry which limits switching. In 2011, Neil investigated the ability of switching in the financial sector in Australia and the perception that switching banks is difficult. And there is no point as all banks are the same. The article takes the view that competition increases when consumers can easily switch providers, but finds through quantitative research that their ability to do so is limited. The article refers to ANZ's submission to a Senate inquiry which found that recent research by Choice discovered that 78.5% of bank customers had not considered switching, 7.6% had switched, and 11.8% had considered switching but had not done so. Half of those who did not switch because the effort required was too high. The article also refers to the commission of a poll in 2010 by the Association of Building Societies and Credit Unions, which found that, and I quote, 40% of respondents had considered changing their banks in the previous 2 years, but 2/3 of this group hadn't because 41% said it was too difficult, 23% said there were fees and charges attached to shifting, and 28% said there was no point at all because all banks are the same. There are competing views. Phil Naylor, the head of the Mortgage Brokers Association, in his complaint to the Senate inquiry, argued that the banning of exit fees will have the reverse effect of increasing competition by causing non-bank lenders to lose their most effective weapon in competition with the banks. So there'll be arguments regarding the technical and financial feasibility about changing the current bank, state and branch BSB account numbering, such as those put by ANZ and Westpac in their submissions to relevant Senate inquiries. However, the incumbent entrant playbook for number portability is very well understood, at least by the ACM, the Australian Communications and Media Authority and the ACCC. That is, there is a good regulatory understanding of the information asymmetry risks and strong mechanisms for dealing with it. So is it all too late? One of the potential risks of a portability regime might be that it really is all too late. However, I think that there are positive signs that the 4 pillars recognise that there are competitive gains to be made by altering the balance of their business models. Consistent with the argument that low barriers to efficient entry and exit from markets are essential to competition, we are seeing changes in the business mix. I mentioned earlier the trade sale of MLC, which is probably keeping iBankers away from this event, and now NAB has also reviewed exit from the custody business. All 4 of the major banks operate in a way that allows for the divestment of underperforming or non-strategic assets. The critical issue is that competition needs to be able to push through. It was George Stigler who coined the phrase, competition is a tough weed, not a delicate flower. What is needed to promote competition is a ban on weed killer. One way of effecting that ban would be to facilitate consumers switching more effectively. That is, to reduce the non-price switching costs. In that way, the competition stability balance might be best served by effective and efficient competition between a small number of innovative but large banks. Thank you, ladies and gentlemen. Any questions?
The most recent pro-competition policy changes were in 2011 when the government banned mortgage exit fees and introduced the tick and flick system where you can authorise your new bank to go to the old bank and carry over all the direct debits and so on. Did you come across any assessment of the effectiveness of those measures?
I haven't come across an assessment of that yet. Naturally, there's an expectation that that will have a pro-competitive effect because it reduces a price-based switching cost rather than non-price-based cost. But as I mentioned, other groups are worried that the removal of the exit fee arrangements has the potential to see shifts from the non-bank sector or the non-traditional bank sector back to the Big Four, but I don't have information on the extent to which that's happened.
Is that on? Yeah.
Yeah.
Rob, you repeated a quote that was attributed to me, but which is incorrect, and I thought I might just make a couple of comments, if I might, because it's perhaps helpful, and maybe not be helpful, to just observe some of the trends that have occurred in relation to competition in the banking industry and the perceptions of competition. I underline the word perceptions. If I can take three particular events where there was a lot of myth around. The first was the Westpac, sorry, Graham Samuel, by the way, at Monash University. The first was the Westpac acquisition of St George. That was very well documented, both in a statement of issues and then subsequently in a public competition assessment, which made it very clear that the reason the ACCC permitted that merger to occur was because there were not perceived to be any anti-competitive consequences. Now, I think that's really important for this reason. We examined 3 or 4 markets. One was that of institutional lending, and St George wasn't a competitor in the institutional lending market, and in fact this was a highly global market that was not affected by any of the events of the preceding 12 months, and therefore it was not considered to be an issue. The second was retail banking, and we did a lot of analysis of the retail banking environment, and what was seen was quite clear, which was first, St George was not a price competitor in the retail banking market, but more importantly, the major banks were not the price drivers there. The non-bank financial institutions were. This was pre the real effect of the GFC, which occurred several months later. The third related to the wrap platform that was held by St George. We did an examination of that. We considered that there was enough competition that the acquisition of that by Westpac was not going to impact on competition. Very interesting though, because suddenly the perception was around that because St George had been acquired by Westpac, well, so competition had been dramatically diminished in the banking sector. And I want to come back in a moment to what competition means in this area. The second one was the Commonwealth acquisition of Bankwest. I was always bemused by that one. Bankwest was funded by $16 billion of concessional funding from London. The Bank of England told us that that concessional funding had to be removed. That was the only thing that was making Bankwest an aggressive competitor with the potential to move over into the east states of Australia. It was very competitive in the west, in Western Australia particularly, and it was made very clear to us that Bankwest would have to refund that $16 billion of its wholesale funding at less competitive rates, which would reduce and in fact neutralise its aggressive competitive stance. So the only issue for us was not whether it would survive or whether it was a GFC or anything at all. That is, in the new environment post-GFC, was Bankwest going to continue to be a competitive operator in the market? The short answer was absolutely clearly no. In fact, there was a real question as to whether it would continue in the market at all, the absence of that $16 billion of wholesale funding. The third one, the most extraordinary misinterpretation put around by a whole lot of people in the marketplace was NAB and AXA. And that was not about a $40 million wrap platform. It was all about a total funds management business. And if anyone cares to examine the details of what occurred there, they will appreciate that our concern was that if NAB had acquired the business, then it would have entrenched NAB as a very, very dominant player in the funds management business. Now, having said all that, because that's just sort of a short try and correct history, but it'll never be corrected because that's perception. But that brings back to the real issue of perception. And what's occurred in this whole area is this, I think, that in terms of competition, I go back to that Westpac St George, the area where politicians have got involved and the analysts have got involved and the inquiries have got involved relates to one discrete area only, and that is residential mortgages. And what happened there was that the NBFI, non-bank financial institutions, were taken out of the market by the GFC. The then Labor government, Wayne Swan, attempted to reintroduce them through the Office of Financial Management by the introduction of, I think, about $16 billion of concessional wholesale funding, but they've never really got back into it, although you're starting to see some impact now with a couple of the more well-known ones that are sort of marketing their wares. When we gave evidence before that Senate committee you talked about, we noted that the primary reason why there was little switching between the major banks was not so much switching costs, but the real problem was it didn't really matter. You know, if you looked at the interest rates that were being charged by the major banks, 1 month ANZ might have had the lowest by 1 or 2 sort of decimal points out. The next month NAB might have had the lowest. The next month might have been Westpac. It tended to move around, and it was hardly worth the bother. Now, what does that say? Well, it says one of 2 things. The first is that in a market where there are 4 big banks and there are a number of smaller banks, including Bendigo, Bank of Adelaide and others, what it says is, well, there's not a lot of gap between them. They tend to follow each other. Although I have to say that, quite interestingly, post the GFC, there was a massive amount of competition occurring in residential mortgages. As I recall, the 2 Sydney banks, Westpac and CBA, decided they were going to go into residential lending with their ears pinned back. ANZ and NAB said that wasn't going to be their way. They were not keen on the low doc type lending that was occurring. They were a bit nervous about it. And NAB in particular went for small business. So in that area, there was a lot of competition to the extent that the result was that Westpac and CBA built up a very substantial market share. Then ANZ decided that it had taken the wrong course and it then moved into residential lending. But I'm not sure that I agree with the inquiry, or with Deb for that matter, that we have got less than a competitive marketplace for banking, particularly residential mortgages. I'm not sure that there is anything you can do to, quote, promote competition. And there's this issue about promoting competition as distinct from a comment you made, Rob, in your last presentation, which is about taking steps to remove impediments from competition. And that's where regulation gets involved and where the ACCC can be involved. I'm not sure the ACCC has either the legal or other capacity to actually, quote, promote competition. That requires markets to be operating in a way, and what tends to happen is the regulation intervenes to limit or to create impediments to competition, which can be very complex and very difficult to undo. But that's because legislators like to sort of get into these markets and to regulate, thinking they're regulating to promote competition. In fact, they're doing otherwise. But I would simply draw attention to a related market which you referred to earlier on, and that is the groceries market. And back in 2008, we did an inquiry into groceries, and we concluded, similar way to the way the FSI has concluded, that in groceries there was, quotes, workable, close quotes, competition. The reason for that had very little to do with duopolies or oligopolies or anything else. It had to do with 2 things. One was some constraints on the expansion of Aldi, which is now being rectified. And the second was the fact that the management of Coles left a bit to be desired in terms of creating aggressive competition. Well, the import from just not far from where you came from, up in Scotland, McLeod, soon changed that. And now I think it's fair to say that what we've got is aggressive competition, yet the structure of the market hasn't actually changed that much. It's a management change and an attitudinal change. And so therefore I query about the extent to which we can promote competition through structural change is distinct from, you know, having in place, in that case, in Coles' case, a single individual who actually said, I'm going to go in here with my ears pinned back and I'm going to drop prices down, 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 and suddenly you've got aggressive competition in the grocery market. And so I query how much we can structurally change a market to promote competition is distinct from having, you know, attitudes change which see significant promotions of one lender as against another.
Thanks very much.
Hello, John Anning from the Insurance Council. I'd just like to ask for your comments on the FSI recommendation that regulation for startups in an industry be modified to encourage entry. I almost asked the question after Marina's presentation, but particularly after a lot of your comments that competition is a tough weed, and also I think you said what was needed was not pro-competitive action, but what you needed to protect against was anti-competitive.
Yeah. So, provided that you don't have a regulatory barrier that comes from what I was trying to say, which is to say you don't actually need a regulatory approach, which is we've got to promote competition. This goes back to the issue that Deb was mentioning. What you need is consistent regulatory approaches that have an objective of not causing a detriment to competition. So that of itself reduces the potential barriers to entry. So the level of regulation is proportionate, and that can of itself encourage entry by not being a barrier to entry, or not being a regulatory barrier to entry. Does that answer the question, or not quite?
Not quite. I suppose I'd be interested in a view on whether, for example, APRA should moderate its regulatory regime to encourage, well, in our sector, more entrance into the general insurance.
Well, it's the normal balance between how do you ensure that those entrants are entrants who are entering into a market to stay, and those who may have nefarious aims and actually are flying in, going to fly by night. They're coming into the market and then exiting. So essentially, you end up, I think, with having to set the regulatory barriers high enough that will provide an appropriate level of consumer protection, but low enough to not discourage entry. And that may well be, in the case of general insurance, by having a proportionate scale in terms of the regulatory burden, so that the large insurers have a slightly different regulatory burden to new entrants, so that you encourage entry, not by we want to encourage entry, but by reducing barriers so that entry is possible. If there are no other questions, what I'd like to do is open up to a broader discussion for the last 20 or so minutes that we've got. So I'm going to go and sit back down at the front because I don't want to stand up here preaching. We had a fabulous conversation from Graham. Are there any other people who'd like to make some comments, any observations, anything that says you're doing it all wrong, you should be thinking about other issues given the project that we're doing at the moment? And I'll come and sit down there and listen to the answer.
Can I ask, Deborah, given what you were saying, would you see the recommendation in the report that the risk weights for capital on mortgages between the big banks and the smaller banks be more closely aligned? Is that the removal of an anti-competitive barrier, or or is it the implementation of pro-competitive measure, and what effect do you think it would have?
I would look at it more like a removal of but I guess we're playing with words when we talk about whether something's a removal or it's an implementation of a pro-competitive thing. But I think it just goes back to the question of getting the balance right. And in this case, it seems to me that it may well be an appropriate way to go. I have to say it's not one that I've expended a lot of time thinking about. But I see the issues in relation to other regulatory barriers as being far more about removal of barriers and thinking about the fact that there may well be 3 ways to do something, and 2 of them may have, this is just a very general view that I have, 2 of them may be ways of doing things that do have an impact on competition, and the 3rd way may have the prospect of just as much success in what it's trying to do. And I guess all my views about that go way, way back to the review of all the regulation that we did around the time of Hilmer. Around the time of Hilmer, every piece of regulation, both at state and federal level, was reviewed to see whether or not it was necessary, whether or not what it was seeking to achieve could be done in a less anti-competitive way, and the results were astonishing when you looked at the individual pieces of legislation. There was wordiness, there were processes in there that didn't need to be in there, sounded like a good idea at the time but served no real process, and it took people from out of the box having another look at it and thinking, well, this is the way we do it because this is the way we've always done it. So it took people who weren't involved, had no buy-in to that legislation, to look at it and think, well, this is crazy. You could do that in 2 steps. Why wouldn't you do that? Is there any reason why you can't do it that other way? Not something completely off the wall, but a way that fitted in with the operations or the ultimate purpose. And in very many, I think there were hundreds of pieces of legislation that were just repealed because really they served no good purpose other than inhibiting competition at that time, and others were left alone, and others could be rejigged to get a better outcome for competition while still maintaining their original purpose. So that's where my thinking on all of this comes from. And it's like the old doctor's thing: do no harm, and that's probably more of an explanation than you thought you were going to get. But that's where I'm coming from.
Deb, that sort of raised, it really answered part of the question I was going to ask, and that is whether we've got these sort of soft references to competition in the APRA mandate and the ASIC mandate, but I think it's quite clear though they might think about it, the balance for APRA is always about financial stability and things of that nature. Do we need that sort of process to start looking at some of the regulatory decisions that are being made by the regulators? Because now we have, certainly in the APRA world and in the ASIC world, lots of decisions which are reflected into prudential standards or into class orders, and which are just books of the damn things. Whether some of those really need to be re-looked at in context, more formally looked at in the context from a competition perspective. But then you've got to ask, well, what competition issues are you really looking at?
Look, I think one of the problems that I see, and I've been looking at regulation overseas in a whole range of areas, and what I see is in very many areas there are unintended consequences, and if people had their brain attuned or their mind attuned to the potential anti-competitive impact, they might do things a whole different way. And that's really all I see. I see this as switching the lights on a little bit more and thinking about other alternatives. And I've been told from the back that happens, but don't think it happens in relation to all processes all the time. So while I'm sure that at a big picture level there is some consideration of it, When you only had to go back and look at those pieces of legislation that I helped review years ago to make you understand how people have a vision and they have an important thing to do and they go towards that vision, and if they don't think about competition law much, it gets done one way when it could be done in another way. Now, I'm not suggesting either that competition needs to be always paramount and always. There's no suggestion that that's the case. The suggestion is have a good think about it. If there's no other way you can do this, or if the public benefit is in doing it the way you want, for example, really well thought through ideas about stability, we'll go right ahead and don't worry too much about competition. But at least have thought about it, at least have looked at the alternatives properly and thought about it. And I think that when regulators have a stability primary focus, they're always going to prioritise that unless you give them a signal that you want them to look at other things as well and justify what they're doing. I think that we did have a system, for example, we had that regulatory review in Hilmer. We were supposed to have a system of regulatory review going forward, and we have had that, but it's a mere shadow of what it was in the beginning. And you know, that's one thing that I've been talking about in relation to the Harper Review. It talks about revitalising that process for all legislation, and I think that's a great idea, having seen the downsides of it once before.
Deborah, if I might say so with respect, those are the most important comments that we could take away from this particular session, the comments you just made. Having been through the National Competition Council and the review of 2,100 pieces of legislation, I can say to you that there were two impediments to removing anti-competitive legislation. The first was vested interests. I mean, they were so clear that it didn't matter. You knew what was going on and the politicians just wouldn't tackle it. And we've still got issues even raised this morning in the Financial Review in relation to taxis and pharmacies and things of that nature. The other one is a bit more difficult, and I have to frankly support you in your own views about regulators other than the ACCC. And I'm sorry, I'm going to take a different line to the one you've taken. My own experience in dealing with fellow regulators has been that there is a culture of approach to competition which comes from having it built into your DNA for so many years that you know it when you see it, and you stop thinking about we ought to regulate in this area because it'd be a good thing to regulate. I was talking the other day with some people who actually I thought would, because they're involved in analysing this area, thought that they'd be well attuned to competition. But we were talking about disruptive technology, Airbnb, taxis and the like. I was fascinated at the level at which they thought regulation might be needed, which was way up here. We spent an hour as I gradually sort of worked through with them, and they accepted that that level of regulation actually wasn't necessary, that really the consumer, properly informed and having an ability to quickly dissolve any asymmetry of information, could actually make sensible choices. You do get into your 3 Fs, your family, friends and fools, and the fools are the hard ones. But then do you regulate at a level that protects the fools from their own ignorance and apathy and thus reduce competition? Or do you ultimately say, average Mr. and Mrs., you've got to start making some sensible decisions of your own, and the way you do it is that you have the information provided to you, and then you can make those decisions of your own volition. Then what will happen is that there'll be regulators will say, well, what we ought to do is we ought to make it mandatory to provide that information. I said, but hold on, competition will do that, because competition will say that he or she that provides the information will be at an advantage over he or she that doesn't provide it, and that gives the consumer that ability to make that choice. There will always be a level at which there has to be a safety net. We talked before about, for example, in Airbnb, which is this accommodation sharing thing. It was put to me, well, what about in relation to what is known as accommodation sharing? That is where the proprietor of the house invites you to share a bedroom in the home, not to share the bed, by the way, but to share a bedroom, right? And should there be any safeguards there? There probably has to be. I mean, ultimately, if there is wrongdoing by the landlord, that'll soon come to the surface. But as I made a comment the other day to these people analysing this, the problem with that is that you've probably got to have 5 or 6 sexual assaults before it becomes known. That's the asymmetry of information. So you have certain protections there, police checks and the like. But it is amazing how quickly regulators, and I mean regulators as distinct from competition regulators, will choose the route of regulation and trying to limit the ability of the average consumer to make a choice in favour of providing circumstances in which that choice can be made.
Can I just add something to that? I did an interview on the Airbnb thing on the ABC, and people were complaining that these people were breaching the zoning laws, and because all of these people were having wild parties in the Uber accommodation. And I said, well, clearly, if you're looking at it from a competition perspective, you don't have the zoning regulation to prevent private people renting out their own houses. You get people to enforce the noise regulations. You don't have that law. You take their bond if they've come in and trashed your house by having a party. They don't get their money back, and next time you might take a bigger bond, and then the person who takes the lesser bond might get the rental and take the risk. But I can't agree with you more. Yeah.
Looks like we might be heading for an early mark. Not that early, but at least a 10-minute early. So I'd like to thank you all for coming along to this session and for the contributions. It's been very helpful.